Welcome to Iron Financial. This is the only explainer you're ever going to need to cut through market weakness, ignore the noise, and forge a truly stronger portfolio. I'm your host, and today we are tearing into a company that literally sits at the absolute epicenter of our current global geopolitical reality. We're talking about Lockheed Martin. We are looking extremely closely at their Q2 2026 financial results today, and let me tell you right out of the gate, there is a massive, high-stakes tug-of-war happening under the hood of this defense giant. Because on one hand, when you're looking purely at the hard metrics, the analyst in me sees a company flashing an absolutely bulletproof balance sheet. We're talking record revenues, steel-clad guidance upgrades, and free cash flow that is frankly staggering. But we have to look at this from every single angle. Because if you put on your market skeptic hat and actually dig into the fine print, you're going to find execution bottlenecks, severe single customer dependencies, and massive reach-forward losses that might just make this stock a dangerous valuation trap. So let's dive into this and separate the hype from the underlying reality. $230.4 billion. I want you to just let that number sink in for a second. That is not a typo. That is Lockheed Martin's total record-breaking backlog as of the end of this second quarter. We are looking at nearly $250 billion in raw material pipeline and forward-looking demand. In a world defined right now by geopolitical instability, this backlog completely establishes the sheer scale of the stakes we're dealing with. It's massive. But here's the thing about defense contractors. A backlog is really only as good as a company's ability to actually execute on it, right? Can they scale production quickly enough? And more importantly, can they convert those future obligations into actual cash today without getting totally crushed by fixed-price contracts in an inflationary environment? So the crucial point we're tracking today is simply this. Can they execute?
All right, here is our battle plan for today's explainer. First, headline versus underlying reality. Second, the segment war room. Third, the cash flow machine. Fourth, upgraded outlook and guidance. Fifth, macro and backlog reality. And finally, our uncompromising final verdict. Let's get right to work.
Section 1. Headline versus underlying reality.
Just look at the sheer magnitude of this year-over-year jump. It is wild. Net earnings rocketed from $342 million in Q2 of 2025 all the way up to $1.8 billion in Q2 of 2026. And the diluted earnings per share? We're looking at an absolute explosion from $1.46 a year ago to $7.94 today. If you're a strict top-line numbers investor, you are seeing an unshakable bedrock of profitability right now. Consolidated operating margins jumped from an anemic 4.1% to a highly robust 12.4%, and total consolidated net sales grew a very healthy 11% year over year, coming in at $20.1 billion compared to $18.1 billion in the prior year quarter. From a 30,000-foot view, it honestly looks like they are firing on every single cylinder, perfectly capitalizing on the radically increased defense budgets we are seeing globally.
But let's pause. We need to look at this with a really healthy dose of skepticism. Because a 443% EPS growth rate for a mature mega-cap defense contractor, that doesn't just happen organically. You have to strip away the accounting noise. The adjusted reality here is that Q2 of 2025 was uniquely, exceptionally terrible because Lockheed had to absorb roughly $1.6 billion in prior year reach-forward losses. Now, what exactly does that mean? It means they severely underestimated the costs on several incredibly complex fixed-price development contracts, and they had to eat the difference. Specifically, last year they took a $950 million hit on a classified aeronautics program, then a $570 million bath on the Canadian Maritime Helicopter Program, or CMHP, and another $95 million loss on the Turkish Utility Helicopter Program. So that massive $1.7 billion increase in consolidated operating profit we're cheering for this quarter, a huge portion of it is quite literally just the absence of last year's massive screw-ups. Yes, the 11% sales growth is totally real, and it's impressive. But do not mistake accounting base effects for purely organic quadruple-digit operational growth. It's just not the reality.
Section 2. The segment war room.
As we noted, consolidated sales hit a massive $20.1 billion base, and the great news is every single segment saw expansion. Aeronautics is the absolute bedrock here, pulling in $8.1 billion, which is a solid 9% increase over last year. Rotary and Mission Systems, or RMS, brought in $4.4 billion, Missiles and Fire Control, MFC, delivered $4.1 billion, and Space rounds out the whole shebang at $3.5 billion. When you see growth across the board like this, it directly reflects increased volume across the entire defense industrial base. They are actively converting that mountain of backlog into revenue across multiple domains: air, land, sea, and space. But to really understand the structural strength of this portfolio, we need to look much closer at the standout performer,
because missiles and fire control is the undisputed star of Q2 2026. Sales in this segment surged an incredible 19%. We're talking about an absolute increase of $668 million compared to last year alone, and operating margins here are sitting at a highly lucrative 14.5%. Listen, this growth isn't a fluke, it's a trend. It is being driven by massive, high-margin munition ramps. We are talking about integrated air and missile defense programs, specifically the PAC-3 and THAAD systems, which alone accounted for $560 million in higher sales. Then you add in tactical and strike missiles like the Precision Strike Missile, or PSM, driving another $100 million in organic growth. The geopolitical reality of restocking weapons globally, particularly in Eastern Europe and the Middle East, is literally turning MFC into an absolute cash forge for Lockheed.
But let's move over to aeronautics and see exactly where the cracks in the armor begin to show. On the strengths column, you obviously have the F-35 program. Higher volume on production contracts there drove a $475 million sales increase. That is the heavy lifting right there. The F-35 remains the absolute cornerstone of NATO's air superiority. But looking closely at the execution bottlenecks, sales on the legacy F-16 and C-130 programs actually dropped by $120 million due to lower volume on sustainment contracts. And it gets a bit worse. Operating profit in aeronautics faced a $160 million headwind due to lower net favorable profit adjustments across the whole portfolio. When your biggest segment relies so heavily on one single platform, the F-35, any sustainment drops in your legacy programs eat directly into your margins. And right now, the operating margin for aeronautics is sitting at just 9.4%.
And honestly, the execution risks don't just stop there. Let's look at Rotary and Mission Systems, or RMS. Yes, they had 9% sales growth, but remember, they are largely just recovering from those massive helicopter program losses we talked about last year. If you look at the highly granular Q2 data, they are actually still taking unfavorable profit adjustments on active contracts right now. They took a $65 million hit on the Heavy Lift program and a $50 million hit on Seahawk programs. Why does this matter? Well, because when you are a defense contractor dealing with fixed-price environments, raging inflation, and unpredictable supply chain bottlenecks, estimating costs incorrectly means your margins bleed out slowly over the entire life of the contract. This is exactly the kind of structural weakness that valuation traps are made of, and it absolutely proves that Lockheed hasn't entirely fixed its estimating models yet.
Section 3. The Cash Flow Machine.
At Iron Financial, we have a saying, earnings are an opinion, but cash is a fact. And the fact today is $2.9 billion. That is the free cash flow generated in just this second quarter alone. To put that into perspective for you, in Q2 of 2025, their free cash flow was negative $150 million. Let's look at the operational level. They generated a staggering $3.2 billion in cash from operations this quarter, compared to just $201 million a year ago. By literally any aggressive Wall Street metric you want to use, this is a phenomenal cash surge. It gives management incredible optionality. It provides the heavy dry powder needed for smart capital allocation, aggressive debt paydown, and most importantly for a lot of you, securing that famously reliable dividend.
But again, let's step back, put our skeptic hat back on, and ask how much of this massive cash forge is driven by pure operational excellence and how much is just accounting timing. According to the SEC filings, this incredible surge was heavily driven by the timing of customer receipts and, crucially, lower tax payments. Specifically, we're talking about massive tax tailwinds, including CAMT relief, that's the Corporate Alternative Minimum Tax Relief, via Notice 2026-7. So while the underlying business is certainly generating robust cash, a really good chunk of this year-over-year reversal is just the U.S. government shifting when the bills are actually due and when the checks are cut. Don't get me wrong, it's a fantastic quarter for the Treasury team, but it's not all pure margin expansion. Investors need to normalize these cash flows to get a true reliable run rate.
Section 4. Upgraded Outlook and Guidance.
Now, if you want definitive proof of a solid foundation, here is the steel-clad guidance upgrade. Across the board, management is raising the bar for the rest of the year. They bumped full-year 2026 sales guidance up to a midpoint of roughly $80.75 billion. They raised segment profit expectations to the $8.5 to $8.7 billion range. They lifted diluted EPS expectations to a very tight range of $29.95 to $30.65. And honestly, most importantly, they raised the target for full-year free cash flow to a massive $7.0 to $7.2 billion, up from a prior max of $6.8 billion, all while simultaneously lowering capital expenditures down to the $2.0 to $2.4 billion range. When a company tells you they're going to make more revenue, drop way more to the bottom line, spend less on CapEx, and generate over $7 billion in free cash, That is a management team signaling absolute, unapologetic confidence to the street.
Section 5, Macro and Backlog Reality.
Lockheed booked $65 billion in brand new Q2 orders alone. Remember that $230.4 billion total backlog we talked about from the start of the explainer? Well, this is exactly how you feed it. The absolute crown jewel of this quarter's order book is the $35 billion multi-year contract with the Missile Defense Agency for THAAD interceptors. $35 billion! The U.S. government and its allies are aggressively restocking weapons. We're talking about over 50,000 rockets, missiles, and munitions used in recent global conflicts that need to be replaced right now just to get back to baseline inventory levels. That $135 billion contract guarantees a huge production ramp for years to come, heavily insulating the MFC segment from short-term macroeconomic volatility and providing incredible multi-year revenue visibility.
And what's really fascinating is they aren't just doing it alone from their domestic facilities anymore. CFO Evan Scott explicitly noted on the earnings call that they are looking at real opportunities to scale production faster through strategic partnerships, particularly over in Europe. They are actively investing to strengthen global defense manufacturing. They've established a collaboration with General Motors Defense right here in the U.S. to tackle supply chain constraints, and crucially, an agreement with Rheinmetall to co-produce ATACMS in Europe. This international co-production narrative is brilliant. It expands capacity without Lockheed having to bear 100% of the capital expenditure risk themselves, and it drastically deepens their roots with NATO allies, pretty much ensuring Lockheed platforms remain the absolute global standard for decades.
But we have to look at the severe scaling risks here. First, complex defense programs are heavily exposed to fixed-price contract estimates. If inflation spikes unexpectedly or supply chain dependencies create delays, say a sudden shortage of rare earth minerals or critical aerospace electronics, Lockheed eats those cost overruns. Period. We saw exactly how devastating that can be with the $1.6 billion in reach-forward losses last year, and we're seeing the continuing bleed in RMS this year. Second, there are immense U.S. government budget uncertainties. We are talking about the very real risk of future defense budget caps, continuing resolutions that just freeze spending at prior year levels, messy debt ceiling fights, and shifting Pentagon acquisition priorities. If the U.S. defense budget suddenly flattens out, this massive backlog could face severe delays in definitization and, more importantly, delays in actual customer payments. So yes, the demand is unequivocally there, but the execution and funding risks are very, very real.
Section 6. Uncompromising final verdict. So let's pull all this together and summarize the opposing views on this portfolio foundation. The bedrock holding case is undeniably strong, right? You have a record $230.4 billion backlog and astonishing $7 billion projected free cash flow surge for FY26, a steel-clad guidance upgrade across all key metrics, and massive international demand driven by that $35 billion THAAD contract. From that purely analytical perspective, this is a highly durable, dividend-paying cash machine that absolutely belongs at the core of a defensive portfolio. But the overhyped defense play case points straight at the structural weaknesses. That explosive 443% EPS growth, it's kind of a mirage masking prior year reach-forward losses. You have sustainment drops in legacy aeronautics programs like the F-16, unfavorable profit adjustments still bleeding RMS margins right now, and the ever-present massive danger of fixed-price contract execution in a completely unpredictable inflationary environment.
Which brings us to our final thought for today. As you look at your own investments, you have to weigh these incredible geopolitical tailwinds against the harsh, ground-level realities of complex defense manufacturing. So I'll leave you with this. Is Lockheed Martin an unshakable bedrock holding that deserves a premium place in your portfolio? Or is it a valuation trap heavily exposed to fixed-price execution risks that could bite back hard in 2027? You have the hard metrics, the margin breakdowns, and the cash flow realities now. It's up to you to decide how you will forge your own portfolio. Thanks for joining me on this Iron Financial Explainer, and stay focused out there.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research and talk to a professional before making any moves with your money.